Hi there, I'm Jason Ayers, founder and president of OptionSource.net, and thank you for joining us to learn about buying call options. Depending on the investor's objectives, there are several reasons why a call option might be purchased. A call option may be used as an alternative to buying a stock in order to profit from a bullish move in the underlying security. An investor may also use a long call option to secure the future purchase price of an underlying security or as a means of hedging the risk associated with a short stock position. The investor who is anticipating an increase in the price of a specific security may purchase a call option as an alternative to going long or buying the underlying shares. The call option will increase in value as the underlying security value increases. The call buyer has an unlimited profit potential as the share value increases, but has a maximum risk exposure limited to the call option premium paid. This chart illustrates the differences between being long the underlying security and buying a call option. Notice that the required capital for the shareholder in this example is $50,000 and is determined by multiplying 1,000 shares by the share price. Alternatively, the call option buyer holds the right to own 1,000 shares at $50 through the purchase of 10 contracts. Since the call option holder is paying $2.75 per share, the required capital is $2,750. At expiration, if the stock increases by $5, the $50 strike call option will now be worth $5 to reflect its intrinsic value. The long call position will result in an 82% return, while the investor who is long the security will achieve a return of 10%. It is important to note that those results are dependent upon the investor's ability to predict an increase in the underlying security. If the anticipated move does not take place before expiration, the option will expire worthless. The maximum risk for the call buyer occurs when the shares of the underlying security are trading at or below the $50 strike price on expiration. At that point, the shareholder is in a break-even position, having lost nothing on the share value. The break-even point on expiration for the call option buyer is determined by adding the premium paid to the strike price. In this example, the $2.75 premium is added to the $50 strike to arrive at a break-even point of $52.75 per share on expiration. It is possible for the call buyer to realize a profit at a lower share price if the anticipated move takes place soon after the call is purchased. This is because there is still sufficient time left until expiration. However, the shares must be trading above the identified break-even point on expiration for a profit to be realized if the call buyer elects to hold the position until the expiration date. Notice that as the share price decreases, the shareholder continues to incur a loss, where the loss for the call option buyer is capped at the premium paid. An important consideration for the investor who purchases a call option as an alternative to buying the shares is the capital requirement. An option premium represents a fraction of the cost required to purchase the equivalent number of shares, which allows for considerable leverage. Equally important is the limited and identifiable risk exposure associated with the purchase of a call option. The call option buyer cannot lose more than the premium paid. However, once again, the anticipated move must take place within the time frame allocated, or the call option buyer risks the option expiring worthless. Call options can also be purchased by an investor who wishes to own shares of a security in the future, but wants to secure the purchase price today. This strategy may be suitable if the capital required to buy the shares will only be available at a later time. To meet this objective, a call option may be purchased at a strike price close to the desired purchase price of the stock. This approach locks in the purchase price of the shares at the strike price and allows the investor to participate in any immediate upside without having to put up the necessary capital to own the shares outright. In this scenario, shares of XYZ may be trading at $50, and a 3-month $50 strike call option is valued at $3. By purchasing one call option, the investor pays $300 in premium to lock in the future purchase price of the desired shares. Regardless of how high the shares rally, the investor can exercise the right to purchase the stock at the $50 strike price. The shareholder has had to put up the required amount of capital to own the shares and assumes the unidentifiable risk exposure if the shares drop in value. The call option holder is entitled to participate in the upside of the stock but cannot lose more than the premium paid. Rather than offsetting the call option, the investor may elect to exercise their right to own the underlying shares if the stock is above the strike price. If the investor decides to exercise the right at expiration to buy the underlying security, the premium paid must be added to the stock price in order to determine the new adjusted cost base of the investment. On the other hand, if the shares decrease in value, the option is likely to expire worthless and the maximum loss would correspond with the premium paid. In this scenario, the investor will have to decide if it is worth establishing a new position. It is important to note that each time a new call option is purchased, the cost base must be adjusted, raising the break-even point of the investment. If an investor is bearish on a particular security, they may wish to take a short position. The objective for the short seller is to borrow the shares from their broker, sell them at a high price, and collect the proceeds. The short seller would then buy the shares back at a lower price, following a drop in share value, and return the borrowed shares to the broker at the lower price. The profit is the difference between the price at which the shares were sold and the price at which they were bought back or covered. The broker may ask for the shares to be returned at any time. The risk to the short seller is if the shares of the security increase in value. They would be obligated to buy the shares back at a higher price. To offset the risk, the investor may purchase a call option. As the share value increases, the short seller is in a losing position. The call option will increase in value to offset this loss. With XYZ trading at $50, an investor may be bearish and sell short 100 shares, collecting $5,000. In order to define the risk, the short seller identifies a 1-month call option at the $50 strike price, valued at $1.50 per share or $150 per contract. By purchasing the call option, the investor is guaranteed to buy to cover the shares at $50 regardless of how high they trade within the month. This chart reflects the results of the short stock position on its own and combined with the long call at various share values upon expiration. Notice that once the long call is added to the equation, losses are capped to the premium paid for the option, whereas the short seller, without the protective call, continues to incur losses as the share value increases. By purchasing the call option, the short seller has limited the potential loss on the position to the premium paid, but is able to profit from the complete move to the downside. It is important to consider that if the call option expires worthless, the entire premium has been lost and the short seller is once again unprotected. The investor must consider which expiration month to purchase based on the expected move of the underlying. A long call position has the same risk-reward distribution as being long 100 shares of the underlying security with a long put option for downside protection. As this risk graph illustrates, the call buyer has an unlimited upside potential for the lifetime of the option and a risk limited to the premium paid. This holds true for the investor who is long the stock but has incorporated a long put into the strategy. This investor will participate in all of the upside that the ownership of the shares offer. However, by purchasing the put option, the investor has paid a premium to guarantee the sale of the shares at a specific price if the share value drops. If the strike price selected is at the price that the stock was purchased, then the investor's risk on the position is limited to the premium paid for the option.